Hi viewers, welcome you once again to Micro Learning. This is Shailaja. Previously we have seen regarding the classical theory of employment given by J.B. Say. And what does J.B. Say says? Supply creates its own demand. So in today's topic, I am going to speak on slide 3.5 to 3.6 of chapter 3, Theories of Employment and Income. Now, today we are going to see Keynes' theory of employment and income. Keynes was against classical economists and he argued definitely that supply cannot create its own demand and there will not be full employment in an economy because they are going through different phases of the trade cycle. So let us see what Keynes' contribution towards employment and income. So Keynes has written a book which is called as The General Theory of Employment, Interest and Money. So you have an objective question here, which here it has been written. Okay. Once you see this, always remember it is 1936. And this is a modern theory. Okay. Keynes is supposed to be a modern economist. So the book written by him is General Theory of Employment, Interest and Money. It was written in the year 1936. And Keynes was against the classical economist. Okay. He had his own thoughts, his own ideas, his own criticism towards classical economy. So, Keynes not only criticized classical theory, but he also advocated his own theory of employment as such. Now, let us see what he has told about his employment. Okay. He says equilibrium can be achieved, full employment and all is possible, but there are possibilities of underemployment. Okay. So, and he says the employment is determined or it is viewed in a short run. So he says all the factors can be used. You can use labor, you can use capital, you can use technology, everything can be used. But while this determines the employment level of an economy. So Keynes' theory was a general theory and he has tried to explain so many concepts and situations in it. Not only about equilibrium but also about employment. Okay? But also the concept of full employment as well as possibility of underemployment. Not unemployment, it is underemployment. That is, the wages that he is getting does not match towards his qualification. So Keynes' theory of employment is based on the view of short run. So according to him, what does he say? Factors of production like capital, supply of labor, technology, efficient labor remains unchanged while determining the level of employment. So capital, labor, technology, all this, he says, remains unchanged while we are determining the level of the employment as such. This is Keynes' view because he was against the classical ideas. Now we can see what is effective demand. Okay, effective demand is also coined by Keynes. He says when there will be effective demand, when there will be effective demand. Effective demand is actually based on your income. Okay, now you get Y stands for income in economics, all of us know that. Now this income is spent for consumption, then plus investment. Okay, so after consumption, whatever is left over stands as savings actually. This savings comes as investment. So effective demand is being determined by the income of the person. Okay, so effective demand is determined by the income of the person. And not only that, the number of goods as well as services that are in the economy. So, Keynes' theory of employment and income is in the principles of effective demand. Now, what is the effective demand? Effective demand denotes money actually spent by the people on products of industries. Okay, so people are spending money. For what are they spending money? To buy the products which has been manufactured by the industrial unit. So the money which entrepreneur receives is paid in the form of rent, wages, interest and profit. This we have already seen in the first chapter, where we have seen the factors of production is being supplied by the households. So in return, what does the firm gives back towards the household? Products, goods and services. Okay, households send factors of production and firms in return send back goods and services. So here money is spent by the entrepreneur and he has to pay rent, wages, interest, and after that what residual is left over is called as a profit. So therefore effective demand is equal to national income. So this is called as effective demand according to Keynes. Now, the first word is highlighted: increases, decreases. What increases, what decreases? Okay, if the demand is increasing, that shows the employment is increasing. Again I say, what is increasing? When effective demand is increasing, that denotes, okay, that denotes a person's income is increasing and the employment conditions are very good. Here you have see the word decline, I have circled. Decline tells you that is the demand is very less. Why is the demand very less? Because there is unemployment problem. Naturally, when your income increases, you spend a lot or you demand for various commodities. But when your income decreases, your demand decreases here. Therefore, the total employment of a country can be determined with the help of a total demand of a country. So, total employment of a country is determined by the total demand for it. Okay. So, total employment of a country is determined upon the total demand of a country. As the demand increases, okay, income or the employment increases. Okay, employment increases, income increases. So, demand again increases. So, according to Keynes' theory of employment, what is effective demand? Effective demand signifies the money spent on consumption of goods and services and on investment. The total expenditure is equal to the national income, which is equivalent to the national output. So, they can ask you what is effective demand or define effective demand by Keynes. So, the relationship between employment and output only, we call it as effective demand. Okay, so demand depends, effective demand depends upon two, which is it? Employment, and the other is supposed to be the output of the economy. Next one is, this is determined by the forces of aggregate supply and aggregate demand. So, when there is high demand, what happens? Supply of the products is increased into the market. So, when supply is increasing, it is understood, okay, that there is lots of income that is pouring. When output increases, naturally the employment increases. Now this is represented by an equation. So what is the equation? Effective demand is equal to income, which is equal to consumption, which is equal to investment, which is equal to output, which is equal to employment. See how they are correlated with each other. It's a cyclical process as such. So effective demand determines the level of employment in the economy. When effective demand increases, employment also increases. When effective demand decreases, what happens? Employment will decline. So it is having a relationship between consumption and investment expenditure. So rate of interest. Okay, people would like to have cash in hand. This is what we call it liquidity. People who prefer to have money in their hand is called as liquidity preference. Now we should know two things. One is when the rate of interest increases, money flows from the people towards the bank. And when the interest rate is decreased, money flows from the bank towards the public. So there is a relationship between money flow and rate of interest. So the rate of interest is determined by the efficiency of capital and investment level. So how is the rate of interest determined? Rate of interest is always determined by the money supply. If the money supply is more in the economy, it shows that the rate of interest is low. When the money flow is tight, it shows that the rate of interest is very high. Right? So Keynes has given an important concept on liquidity preference. What is he says on liquidity preference is based on three motives: precautionary, transaction, and speculative. Okay, now what is transaction? If you use your money for day-to-day activity, it is called as a transaction. Precautionary, you keep it very safe for your future, it is called as precautionary motive. Speculative, which is to be in circulation, it flows in the economy. So this is the three liquidity preference is based on three aspects: transaction motive, precautionary motive, and speculative motive. So marginal efficiency of capital, okay, depends upon the prospective yield of capital assets and supply of capital. Okay, so MEC is dependent on two. What are they? Prospective yield of capital assets and supply price of capital. Now you have a worksheet. What is effective demand? Okay, so what is effective demand? Effective demand denotes nothing but actually money spent by the people on the production or the products of industry. Okay, then define effective demand according to Keynes. So there is a definition given by Keynes on effective demand. Then formula to equate effective demand: ED is equal to Y, which is equal to C plus 1, which is equal to output, which is equal to employment, which marked a turning point in the development of modern economic theory. Next one is, what are the three motives of liquidity preference? What are the determinants of consumption function? So those who are watching the channel for the first time, please subscribe. Click on to the bell button for further notifications. Thank you.